Welcome all to our latest webinar here at Pangea Risk, where we will be looking at opportunities in emerging markets and whether these markets will form the new frontier for private credit. After years of underperformance, emerging markets are now back on investors' radar, largely driven by changing global dynamics. Private credit flows are also rising, yields are compelling, and emerging market fundamentals are becoming more disciplined. Today, we will explore how Africa, Asia, and the Middle East are capturing this moment and unpack the cautious optimism in frontier markets. Today, I am joined by our Head of Risk Forecasting, Bilal Bassiouni, Head of Asia, Saif Islam, and our Africa analyst, Jack Brodsky, who will take us on a regional tour of where private credit is going, as well as touch on private capital and why 2025 could mark a structural turning point. Welcome to you all. Private credit has ballooned from around 200 million to over 1.2 trillion US dollars globally in recent years, but less than 10% has reached emerging markets. That's now changing. But what's driving this reallocation and how does it reshape the risk calculus compared to traditional sovereign lending? Saif, I want to start with you and look at some of the dynamics in Asia as a launch into this discussion. As we know, Asia's emerging economies, especially India and several Southeast Asia countries, are showing strong equity and debt market recoveries, and the MSCI Emerging Market Index is outperforming the West this year. So, Saif, how sustainable is this performance, particularly given slowing China dynamics and tariff pressures?
Hi, Abby. I think this performance is sustainable to an extent, mainly because some of the strength is underpinned by robust macroeconomic fundamentals in certain countries. You mentioned the emerging markets index. I mean, if we look at the MSCI Asia Pacific index, it's up about 20% this year. And there are several key drivers for this. For example, some regional economies are delivering better than expected growth. The US has reduced tariffs on most Asian countries. And investors are increasingly looking to reduce their exposure to the US markets for various reasons. And the broader euphoria and enthusiasm regarding AI and semiconductors and data centers across Asia. But we also can't ignore that the global economy is going through a volatile period right now, and that affects Asia as well. Take India, for example. Its stock market was one of the first ones to bounce back after the US announced the so-called Liberation Day tariffs in April, and it's still performing relatively well. But at the same time, in the first 9 months of this year, foreign investors pulled about 20 billion US dollars from the US, from the Indian stock market. And that's partly due to the trade dispute between the US and India and 50% US tariffs on Indian exports. Now, China is obviously a much more influential player in the global economy compared to India. So if the US and China can't agree to a durable trade agreement, it's quite hard to see how Asian markets could remain insulated from the fallout.
So with that in mind, the private credit market is actually growing rapidly in Asia, right? So are there specific risks or challenges that are more unique to private credit investing in Asia than perhaps the general investment picture?
Yes, it certainly comes with some risks and challenges. One major issue is uneven levels of transparency. Many borrowers are privately held, mid-sized companies with limited public data, which makes it harder to assess creditworthiness and monitor performance in general. Disclosure standards differ widely across Asian markets, so investors often face information and valuation gaps. There are various legal and regulatory issues. Each country has its own lending rules, bankruptcy laws, and collateral enforcement procedures. In some countries, maybe Indonesia or Vietnam, recovering assets after a default can be quite slow or costly. And generally speaking, cross-border enforcement remains complex. There is also currency and liquidity risk because loans are often denominated in local currencies, but many investors raise funds in US dollars. So currency swings can heavily affect returns. And also, and this is not an Asian issue, it applies generally. Private loans are not liquid, meaning that they can't be sold if conditions worsen. And last but not least, Asia's private credit market has never really faced a deep recession at its current size. And because of this, it remains quite untested under stress, which is why investors should certainly have strong due diligence and risk mitigation mechanisms in place.
Thank you. And I think there's some sound advice towards the end of your answer there, Saif. Thank you very much. Bilal, I want to turn to you now and look at what's happening in the Middle East. I think overall the Middle East fiscal expansion and specifically diversification push from Saudi mid-market financing or to infrastructure-backed credit, it's really drawing unprecedented attention. Now, how should private credit investors interpret this fiscal momentum? Is it a sustainable base for new investment, or is it more of a temporary phase, perhaps tied to high oil revenues?
Yeah, I think that's a very pertinent question, Gabby, here. So particularly over the past few years, 5 years to be particular, governments in Saudi Arabia, the United Arab Emirates, and Qatar, or more closely the GCC countries, have channeled a lot of their oil revenue into programs which are designed to broaden their economic participation. These policies have financed a strong wave of infrastructure, logistics, and industrial projects that require from medium to long-term financing structures. And within this environment, private credit here complements rather than actually replaces overall public expenditure. So it functions almost as if a bridge between sovereign liquidity and corporate capital needs. In this case, it provides flexibility where banks are constrained by regulation or exposure limits. But it's also important here to see the Middle East as almost a tale of two cities. You have your oil importing countries and oil export countries. The ones who are quite oil dependent in terms of imports, like Egypt, Jordan, Syria, and other North African countries, face much more difficult fiscal positions, unlike your known oil exporters in the GCC. So those conditions really vary dependent on the liquidity and foreign exchange reserves positions of these countries. But overall, the fiscal base that we've seen, particularly in the GCC, helps make this transition quite robust. As public debt remains low by international standards, reserves are substantial, and budget policy has become more rules-based than in previous cycles. So overall, this combination provides a very, very strong buffer against commodity price fluctuations and reduces the risks of abrupt fiscal contraction. So at the same time, the governments have demonstrated a willingness to moderate their spending when necessary. Again, this is quite different from what we've seen a decade ago, for example. So and also are able to draw on their sovereign investment vehicles to stabilize liquidity at times of fluctuating oil prices. Overall, so for private credit participants, this policy coherence in the GCC especially is encouraging. It indicates that fiscal expansion is a function, or is not only a function of oil price volatility, but part of a structured long-term vision around reallocating national wealth and diversification.
And it's certainly going beyond policy and vision. And in fact, several Gulf countries have introduced new bankruptcy and insolvency laws, really to harden their position here. So, how much progress has been made? And perhaps, if we look at the progress, are there certain weaknesses that remain for private creditors?
Yeah, again, so for historically, debt resolution in the region, quite generally here, relied on administrative negotiation or political intervention to help ease the situation. Now, that model historically limited foreign participation in the credit markets because outcomes were uncertain and enforcement also dependent on influence rather than on procedure or international standards. Now, the recent reforms that we've seen, including, for example, here, Saudi Arabia's bankruptcy law, the United Arabs' updated restructuring regime, and the codified systems in Bahrain and Oman, have all begun to establish a predictable process for debt adjustment, liquidation, and creditor recovery, which also introduced the reduction of the almost perceived legal arbitrariness around the process, and improved overall confidence in the enforceability of contracts. So the existence of specialized also commercial courts, professional trustees, all of this has further strengthened the framework by ensuring that disputes are adjudicated according to defined legal principles rather than discretionary mediation. And it's also important to note here that despite all of these improvements, the institutional environment is not it remains quite uneven, as many countries have yet to test these frameworks through complex restructurings involving large state-linked enterprises, and the precedent will take a lot of time to form. But nevertheless, the trend is quite positive. The direction of reform demonstrates that a regional undertaking, and again, I need to emphasize, especially in GCC countries, which are supported by very strong fiscal buffers, helps that the credibility of private credit markets integrity will likely be stronger over the coming few years.
Thank you. I think one final question I'll ask on the Middle East side. Political stability and policy continuity have certainly been described as a number of markets in the Middle East's strengths. But in practice, how does centralized decision-making actually affect the longer-term risk environment?
Yeah, so when we look at this form of governance, it allows for coherent economic planning and also rapid policy implementation, unlike where policy is quite contested at parliamentary level or in cabinet. So and also if all of this is tied to a strategic national program, such as what we've seen in the GCC, such as Saudi Vision 2030, or the UAE's economic agenda for 2031, or Qatar's national vision for 2030, all of this is executed within a consistent framework that extend beyond any quick annual budget cycles. So these are long-term projects that have very strong frameworks that carry budget and long-term planning. So this continuity really here offers private lenders a high degree of predictability over regulation and over also fiscal policy. And the integration of sovereign wealth funds that we've talked about earlier into this domestic development agenda will help align the state, but also with the market interest that we see from around these developments. So these funds also will provide strong liquidity and anchor private investment within the cycle, reinforcing the perception that key economic priorities will be maintained through future policy cycles. So I think that's from the positive side. If I can quickly just also speak about some of the political risks that can form out of this decentralization. Policy direction can also hence be heavily associated with some individual leadership agendas, and changes in leadership or adjustments in domestic priorities can quickly translate into shifts in spending patterns or investment focus. And again, because of how dependent some of these GCC countries are on oil markets, despite the strong fiscal buffers that they have in the sovereign wealth funds and reserves. But outside of the Gulf, in countries such as Egypt, Tunisia, and Jordan, the combination of the that limited fiscal space and the social pressures create a different political dynamic, one where external funding and administrative measures can change abruptly in response to any forms of economic stress.
Now, Jack, I want to turn to you and explore some of the dynamics we're seeing in Africa. There's certainly been some landmark private deals, including Gencor's Angola refinery, for example. I know there's been a lot of interest in Kenyan renewables as well, often filling gaps left by constrained multilateral or even bank lending. So if we take a step back first, historically, why have private creditors been reluctant to enter African markets?
Yeah, that's a really interesting question, Gabby, and I think it partly comes down to trust. In a survey by GemCorp, 65% of private credit allocators said that political instability has been a real deterrent for investors in the past. Since 2020, we've seen regime change and coups in Burkina Faso, Gabon, Guinea, Niger, and most recently Madagascar. And the knock-on effect of this is unpredictable policy changes, whether it be to mining legislation or expropriation laws, really damaging investor confidence. Local currency volatility is another factor. The unpredictability of the Nigerian naira and the Ghanaian cedi, in particular over the last 2 years, really kind of puts something behind this. And perhaps most of all, I would say it could be anxiety over debt distress. External debt has soared in Africa in recent years, with the number of countries in debt distress or at high risk of debt distress rising from 8 in 2014 to 23 in 2025.
Now, you've introduced some very recent numbers there. What has actually changed now? What opportunities are there that might be driving this interest in Africa, and how should investors manage them?
Yeah, well, we know that the US has dominated the private credit market historically, but in recent years, this market has become crowded and competitive. Some might even say saturated. So for investors in search of value, emerging markets offer assets at a lower price. They do carry more risk, but there's growth runway that matches this. And Africa's enormous growth potential is hard to argue with. The population is going to balloon in the coming years, accounting for a quarter of the global population by 2050. So there'll be vast numbers of young people ready to enter the job market, ready to drive the economy forward, just in need of investment to do so. And if you combine this with the vast natural resources on the continent, Africa holds 40% of the world's total mineral reserves, 12% of oil, 8% of natural gas. And we've seen the value of precious metals to power our phones, our cars, batteries, and everything in between. So no one expects demand to go anywhere but up. And there have been promising signs too. Economic growth in sub-Saharan Africa is up from 3.5% in 2024 to 3.8% this year, with further growth forecasts in 2026 and 2027. So for investors looking to manage this risk-reward benefit, I would say due diligence and local expertise are really essential. Working with local partners or studying risk through quality forecasting feels like it will be very lucrative for investors willing to move capital into Africa.
Oh, thank you. Thank you so much, Jack. Thank you, Bilal, Saif, and Jack. And of course, a big thank you to everyone who has joined us today. What I think is clear from this discussion is that private credit, as well as equity, are not only returning to emerging markets, but will have the capacity to evolve them. Real structural changes are underway, stronger macro discipline for sure, deeper local capital markets, and new vehicles, perhaps, that can bridge the financing gap left by traditional lenders. And as we've heard across Asia, the Middle East, and Africa, opportunities are certainly growing. Thank you for being part of the conversation today. Until next time.